JPMorgan's a best-in-breed bank. It's up 22% so far this year, but you recently decided to close out your position. Why is that?
Yeah, because it's up 22% this year, and the S&P is only about 14–15%. So it's been a great outperformer. We took advantage of the London whale in the summertime when we were buying in the low 30s, when everyone didn't like it, and it was trading below tangible book value. Now it's trading at 1.1 times tangible book, and we just took our profits.
Okay. Now, I know that the capital markets business is sort of a questionable going forward for them, a profitable business there. But shouldn't their buybacks and their repurchase programs and dividend hike help offset that going forward?
I think it will. I mean, that's the biggest question, right? I mean, what are investors going to focus on for the fourth quarter? Are they going to focus on that capital markets could be down 20, 30, 40% year over year? Maybe. But JPMorgan has great offsets, right? I mean, they do have housing, they do have credit card, they do have a lot of great businesses, and even just core deposits growth. So there's that. That's the negative, the capital markets, and the positive is clearly they're going to be able to be buying back shares again. They're going to buy as much as $3 billion. They'll probably raise their dividend. I just think that we made the easy money, and I think that there certainly could go higher. But if you look at what we own in Action Alert Plus, we own another big bank in Wells Fargo, and we like that because of housing. But we also like that because I think that the net interest margin concerns are way overdone. And the other bank that we own is KeyCorp, which has gotten just destroyed because the regional banks have been hit on the spread business concerns, and that again is net interest margins. If there's one small bank that actually has opportunity to grow their NIM, it's KeyBank, and they demonstrated that in their third quarter. It was one of the best quarters in the group. So those are the two we're playing. We like AIG, and then of course we're looking at MasterCard.
Okay, now JPMorgan, I know you mentioned the valuation there at 1.1 times. How does that compare to its peers? And it sounds like you do believe in the story, even though the valuation's a bit high. So what price could you potentially get back into it? Oh,
sure. I mean, if the stock fell back to the mid-30s or upper 30s, we might take a look at it again. But again, I think if you look at, and it's on the high side in terms of valuation, 1.1 times book. Wells Fargo is actually more expensive on a book basis. But again, I think you get more housing exposure with Wells than you do JPMorgan. JPMorgan is a little bit more diversified. So that's why we're playing, that's why we held on to Wells, and the stock actually has not done as well as JPMorgan. So I do think you can see a catch up there. And again, I think that yes, best in breed bank, it's a fabulous company. We were happy to own it, happy to be able to pick it up at 31, but it's time to move on.